let's try and pick apart some of the reasons why shares could be a better option for financial independence. And we'll try and compare it to property and see how those things kind of stack up against each other, some of the pros and cons.
As we know, property is very popular in Australia, probably the most popular way to invest your money. And, there's some good reasons for that. It has a fairly strong track record in most places over most periods. So it's got good, healthy history. There's pretty much been no instances where, the property market has crashed to zero or anything crazy like that. And we're a fairly stable economy. And then probably the biggest benefit that really helps us stand out is your ability to get easy access to cheap leverage. Basically, you can get a cheap loan for a big property.
And so what the leverage helps you do, which you're probably aware, it helps you magnify your gains. So if you're getting a certain level of capital growth on your property, because you only have a certain amount of the property is your capital and the rest of it is been paid by debt, then the return on your capital is then magnified because you haven't funded the whole purchase with cash. And so that can be the magic when it comes to property investing, is using leverage and getting some decent capital growth and getting this magnified sort of a return. And so when that happens and when it works, you're obviously going to get a much better return oftentimes than you would with a cash funded share portfolio because of the magnification of leverage. But it doesn't always work that way. And there are some other things to consider, obviously, like the upfront costs and then any negative cash flow that you might be having to pay for as well, and whether the mortgage's principal and interest might be sucking into your income a little bit further. So there's a few things to consider, but generally speaking, the leverage helps you magnify your gain. So that's when it can work out quite well. So that being the case, why would someone then not bother with leverage, and why would they consider using shares for financial independence instead, Hayden? Like if they're going to have this idea and maybe they want to build up equity using property and using debt, then that can seem more enticing in many cases. So why would someone consider the opposite choice and go with the share portfolio?
I think one of the big things would be no real hidden costs and hidden gotchas when it comes to shares. You buy it, it goes up usually. There's some small fees in it that they're taken out of the performance, so it doesn't even feel like fees. But, property has a risk and an overhead to it, where if you're renting it out to tenants, what are the tenants going to do? Are you going to get very difficult tenants? What happens when there's vacancies? What happens if they damage something? What happens if something just breaks? The last rental I was in 22, the hot water tank just exploded one day under the sink, and I think it cost the landlord like $1,300, which at the time was like 4 weeks of rent, and that's not to say that there's strictly a negative economic outcome from that, but there's certainly a lack of simplicity and there's a volatility that comes from that.
Another thing that's probably worth mentioning is because you can get started with very little money, you also don't need to take on any debt to get started. That's not really the case with property, where you often need to take on a mortgage, sometimes a big mortgage, to get in and get started and actually start earning returns. So with shares, obviously, most of the time people are just funding that portfolio just with cash savings. And because there's no debt involved, that means there's going to be a positive cash flow situation from day one. So we'll be receiving dividends throughout the year, which, like I said before, you can choose to reinvest those, or you can even just see it as a side income and use that to fund some of your lifestyle if you want to as well. I would say it's a more relaxing way to invest in a sense, because you're never required to put your hand in your pocket to fund expenses. It's always going to be more cash hitting your bank account or more cash coming your way with a cash funded portfolio, rather than having to worry about debt repayments or interest rates or ongoing expenses.
I mean, the big thing is it can't go below zero, right? That's the worst thing that can happen. Whereas there are other investments where, because of the way they're set up, like investment properties, you can go below zero. You can sell it and end up with less money than when you started. That can't really happen with shares. And to your point about relaxation, that's another big element that can play for people for sure. Another big benefit of shares over property is that you have a lot more control with like how that share will contribute towards FI. As an example, there are some Australian-based ETFs that the actual price of the stocks you buy don't go up very much at all, but they pay a lot of dividends, like a lot of that passive income from day one. And then there are other things you can buy, particularly in the US is the most common place you see it, where they actually don't pay you any dividends ever, but they just grow at like a fairly insane rate. And that's not to say one is strictly better than the other, but if you are like, I don't need passive income now or at all in the next 20 years, maybe it's beneficial for you and your circumstances to look at the one that grows massively. Whereas with an investment property, to some extent, you're always kind of looking at the same story. It's always probably going to grow at roughly the same rate, and rents will kind of be roughly the same, and you have slightly less control if you want to do something more specific for your circumstances.